Hi, welcome to Quantist Investment. Today, I'd like to share with you the results I found, the research that I did, and how much would U.S. Treasury bonds will drop in price if their yields rise instantly right now. My motivation is because the bond yields are at the 4% level, which mentally is high, and the bond prices are low. If we look at some of the data, the 10-year Treasury yields is 4%, something like that. 20 years is a little higher and 4.3%, and the 30-year is lower than the 20-year at 4.2%. Just by looking at the three numbers, we can picture a little bit of the inverted yield curve situation. The longer yield should be higher, not less. We can just think about, like, if you are investing something longer, you want more return. Shorter, you want shorter return. Same with the opposite situation, that when you lend money for longer, you want more money back. Just to feel how cheap the bonds are, I took some of the historical charts of the yields. The 5-year one at 4% level, it traces back to 2008. That's when the number is 4, and 2000 to 2005, the same thing. So we can say it's at 23 years, 20 year, something low. If we look at the 10-year one, it's the same thing. If we look at the 30-year one, the difference is it's only at the 2007 to 8 level. It does not go back to the 2001 to 2005 level. So we can have a little conclusion here that the inverting yield curve right now is worse than before in 2001. Because back then, the 30-year Treasury yield is not as low, it's higher. So it's more normal in 2001, the yield curve. Into today's main topic is how much do bond prices will drop according to their durations. I have a calculator that will return a percentage drop if the yield increases or decreases. That will make the bond prices increase. But anyway, today the results are for the 5, 10, 30-year Treasury bonds, and assuming they're all 4% in yields, and the yields will increase by 0.5%, 1%, 2%, 3%. They all pay semi-annual coupons on the rates of 4.13, 3.38, 3.63. The numbers are from online sources. I'm not worried about the authentic, whether they're fake, but they're real, based on their trading data. First situation, yield rises by 0.5%. The 10-year Treasury bond will drop 4% in price. The 30-year one will drop more than 8%. Yield rises 1%. The U.S. 10-year Treasury bond will drop almost 8%. The 30-year one will drop more than 15%. I will not go on and read all the data, but for yield rises 2%, it's really bad. The 30-year bond can drop up to 28%. Even worse when the yield rises 3%. So the next question is, how likely is the yield will increase that make the bond drop in price? That will greatly hurt our portfolio of bonds. And especially, the worry I have is they're government bonds. So no default. With no default, they're still lost. Is it worth it? I don't know. So many people are talking about the Fed may lower rates. There are many people talking about it. raise rates slowly, hike rates more, the rate stays the same, all that. But the situation I want to talk about is the Fed stopped raising rates, but not lowering rates, making the level of the federal funds rates right now either slowly increase or stays the same. Does that make the mid-term, long-term yield to increase? If the inverted yield curve, the situation got resolved, yes, it has to. They have to increase because the federal funds rate is corresponding to a short-term rate. The Fed's funds rate is 1 day rate. It's short-term. It'll affect the shortest term. Which what I mean is the short-term rate will be, the number will be close to the federal funds rate. So I looked it up that the U.S. 1-year yield is at 5.33%. If we compare this number to the 4%, which is my assumption doing this research, is 1.33% in difference. So just for the midterm to long term, the 10-year and 30-year yield to match up with the short-term one, they'll have to increase by at least 1%. Let alone to fix the inverted yield curve situation, they'll have to be a little more so that the curve will look upwards, not flat. Then it's a 1% increase in yields. 1% increase in yields, an 8% loss in 10-year bond, a 15% loss in 30-year bond. How does that feel if we lose that money? And by the way, if it's 3%, it's a lot worse. It's like a financial crisis in stocks. Almost 40% loss in our portfolio. It's really bad. So compare the previous numbers I mentioned to stock. I chose SPY for comparison. It's kind of like a standard index that we can compare any portfolios or any assets with. Otherwise, we would just invest in SPY without any consideration of any other assets, right? So SPY, this distribution of returns is choosing a random year, a 252 trading days in history from 1993. That's when SPY was created. Randomly selecting a span of 1 year, and the results are here. We don't see too many times that the SPY will lose more than 20% if we invest in it for a year, right? 20%. So if I compare to the 1% increase of rate or 2, it's 15%. It's at this level. How much chance do you think that the SPY will give you a negative 15% if we invested in it right now? But if we invested in the 10-year, 30-year bonds, what do you think the chances? I don't know, but it's up to everybody's. But the last question is, with this risk existing in bonds, is it worth it to invest? Because we want returns. Otherwise, we wouldn't invest in it. Otherwise, or we could just invest in stocks. No, not a bond at all. We don't. So if the yield stays the same, it's like I mentioned before, it's a 4% yield, 4 point something yields, locked in return, and the possibility of a great loss, unless we are betting on the decrease of yields, which will give you a lot of earning opportunities because the duration works both ways. If the yield drops instead of rises 3%, the 30-year bond price will increase almost 40%. it's a bet. But without this thinking that the yield will give you so much, will drop so much, it's a something we need to think about if we invest in bonds right now. Thank you.